on this. Teng is founder and MD of Money Manager Capital Dynamics. He's in Singapore. Teng, thanks very much indeed for joining us. Before we get to your expectations for growth here, I want to just ask you, is this an economy addicted to stimulus?
No, that's from a very short-term point of view. It's addicted to development.
Well, with that development comes infrastructure spending and infrastructure investment here as well, which in a way kind of distorts what's really going on.
Infrastructure spending has been shifting. It has been shifting away from the coastal areas to the western parts of China. I think if you look at what is happening in the center to the western part, you see infrastructure spending still pretty strong, but not in the developed coastal areas of China.
Okay, let's just have a look then at what you are predicting for 10 a.m. Beijing time when these numbers are finally coming out.
I don't think it matters whether it is 7%, 7.2, 7.4, because it's just 3 months. I think if you're looking at a development process that's taking 30, 50, 70 years, 3 months is actually just a very tiny portion of that process. I'm not particularly concerned with what the number is at 10 o'clock.
Dan, let's just quickly look at these China futures that just actually have just come into play, and they're signaling further declines. Stocks falling nearly 8%, of course, you remember yesterday. Biggest drop, I think, in more than 6 years, and they're expecting actually a big drop here as well. These futures are down by nearly 10% currently in the mix. Now, what's going on here? I mean, you know, we had, of course, that effective margin call take place, which has affected all those brokerage houses. But what is that telling you about liquidity in China?
I think the rally was overdone. You get 60-70% rise in about 6, 7 months. By any measure, that is pretty overdone. So I think even if there had not been these curbs on the margin, the market by itself, there were already signs that the rally was pretty exhausted from a very short-term point of view. So it was due for a pullback. Now, whether it's going to be 1% a day or 8% over a day, again, this is a market that is still developing. It is still not sophisticated, and this sort of volatility, it's a feature of a developing stock market.
So do you foresee, you know, declines for a while or a rapid gut check before we kind of stabilize?
Oh, yeah. I think the rally was overdone. I think the Shanghai Composite should probably go back to the 2005, 2007, which will be a lot healthier than what it is now.
All right, well, you know, we've got those export-import numbers, the trade data signaling that the global economy is doing well. How much of the global economy is actually being given a lift from this lower oil price?
In the longer term, there will be a lift. But, you know, Rich, whenever there is a major asset price, whether it is oil or property or stock market, whenever they change rapidly within a short frame of time, there's always the worry that there's a lot of adverse impact from that rapid change. So I think over the longer term, meaning over 5-10 years, the lower oil price will definitely be a boon for most economies throughout the world. But what I think is not anticipated is that oil price, first and foremost, we see oil price dropping to about $20, $40 per barrel. I mean, I've been expecting that since last year. And the major worry is not that it's going to drop to 20 to 40. The major worry is that it's going to stay low for the medium term, for the next few years. So that, I think, is something that the global economy has to adjust in the next 12 to 24 months. A lot of the investment growth, a lot of economic growth in many countries have come from investments related to the energy, whether it's traditional or alternate energy. That will have an adverse impact first. And the benefits will probably come in beyond maybe the next 24 to 36 months. Don't forget, I think the U.S. economy is still deleveraging. Households are still trying to reduce debts, and they are trying to maintain a savings rate that is not too low. So I think it's not like in the mid-'80s where oil price plunged suddenly and then it was great for many developed economies. Here you have a situation where households are still in a pretty, I wouldn't say panicky situation, but in a situation where they will want to restore their balance sheets. So the drop in oil price may not immediately lead to a offsetting growth in consumer spending.
Tan, great having you on the program as ever. Tan Teng Abu there from Capital Dynamics,
Hi.
where he is the founder and managing director. We're